This section, after scanning M1, M2, M3, we're going to talk about how to perform trigger analysis. What is trigger analysis actually? It is an examination to find the catalysts that allow you to analyze and enter a trade, whether it is a buy or sell. So it's like something that sounds like a bomb, right? Because there's a trigger to it. There's something that makes you confident to enter right then and there. So, after we've done the basic analysis, which is finding the trend, then looking at the area, gap pattern, etc., we move upwards to find smaller details that makes us confident to execute the trade. Now, trigger analysis consists of two main components: candlestick patterns and trading indicators. So, what are candlestick patterns? Candlestick patterns are formations of candlesticks that can be used to analyze the trend of price movements. So when you see a certain candlestick pattern, it makes you confident to either enter, buy, or exit, sell a trade. That's one function of candlestick patterns. Then, the second component is trading indicators. Now, as I've mentioned before, indicators are supplementary, but here we also explain that indicators can serve as one of the sources for conducting leading analysis. So, what are the indicators? Indicators are a collection of statistical data summarized and visualized into a tool. We use these tools because they contain historical data. From this data, which essentially means without this historical data, we could still analyze using our eyes, observing price action. But here, indicators help like cherries on top of a cake, adding sweetness. Now, let's talk about those candlestick patterns that sound fancy. Let's start with bullish patterns, which are candlestick patterns that serve as a basis for taking buy or long analysis. So, when you've already identified a buying area and a bullish pattern, then we look at candlestick patterns. Usually, I observe candlestick patterns on the M15 time frame. Why M15, you ask? Because M15 is the Goldilocks time frame. Not too big, not too small, just right. If it's smaller, like 5 minutes, it is too short. M15 is just about right. First off, there's the hammer. What's a hammer? A hammer is a candlestick that looks like a hammer, just like the one you'd find in an office for hammering. So, the analogy is like when you're playing at a kid's station and there's a game where you hit a bell or a button and the ball goes up. It is the same here. So, when you see a bullish hammer, it is basically means the price is going to be pushed up because it is protruding. You can hit it to go up. It is like that. Steady condition and okay, consolidation move. Then there's the inverted hammer, which is also a bullish candlestick pattern. Here, the shape is like a hammer but upside down. Maybe this hammer has been used to hit. It is heavy, probably knows it. So, it is brought down to go up. Even though it is a flying hammer, when it appears in the market, it indicates bullish movement. So the price might go up after you see an inverted hammer. Okay, there's an inverted hammer here. All your analysis is correct. Suppose you're already long. Look at the support. Then there's a pattern. Suppose it is flyweight. When you look at the smaller time frame, see, the inverted hammer is solid for you to execute a buyout. Now, the third one here is the bullish engulfing. Bullish engulfing indicates a strong bullish momentum. So, the candlestick is bulging, the body is fat, really solid, indicating that there's a large volume entering the market, represented in the bullish engulfing. For example, in daily Bitcoin chart, when a bullish engulfing appears, it indicates a strong upward momentum. So when you see a bullish engulfing, the wisest step is to also go long instead of short because the upward momentum is strong. You should ride the wave. Why would you go short? You are immediately hit because following the buy is powerful. Then, secondly, there are bearish candlestick patterns. We've talked about bulls, now let's talk about bears. What are bears like? When you see bearish candlestick pattern in the market, it indicates that there's a possibility for the price to go down. So, what are these bearish candlestick patterns? They are similar to bullish ones, but the opposite. It is like there's a team Apple representing iPhones, and then there's P, Ford in the bearish team, and its opponent is P, Brief Roulette. It is always an ongoing battle, but with both sides claiming that bulls or bears are the same, right? Candlestick is also a paraphrase. The first one, there's the hanging man. The hanging man is a red hammer. Why is it called a hanging man? It is like a person hanging their head. Yeah, it's really like someone hanging their head, performing a self execution. The hanging man indicates that the market is already overbought. That's why it is hanging. And what happens when the hanging man appears? The tendency is when the hanging man is seen in the market. The market wants to reverse from bullish to bearish. Usually, when the hanging man is accompanied by high volume, it indicates a drastic and very substantial downward reversal. Like this, it is drastic. The downward movement will be as much as 20% if it's in the daily Bitcoin chart. The second one is the shooting star. What's a shooting star? It is a falling star. And how does it look? There's the head of the star, and then it points downwards, and there's something at the back. There's a tail. The tail is usually depicted as smoke or vapor. So here, this is the head, this is the smoke following below, and the back going down indicates a reverse hammer, red in color, or a red colored hammer, indicating a reversal. When it appears in the market, it indicates a bullish movement, so the price might go up after you see a shooting star. Now, the third one, similar to bullish engulfing, here we have bearish engulfing. Bearish engulfing indicates that the bears hold a very strong momentum to push the price down with high volume. The body is full, almost no small wick here. So what happens? The lowest and highest prices are almost the same. Like it doesn't give any chance, not at all, for anyone to step in. Whether you want to buy or not, you're not invited first. What happens? So with bearish engulfing here, it is a sign that there's a tendency for drastic downward movement, especially when bearish engulfing is also supported by high bearish engulfing volume. It is devastating. An example in daily Bitcoin chart. So we've discussed candlestick patterns earlier. Now let's move on to trading indicators. So trading indicators are complements. What can you use as a trigger to prompt you to enter a position? Basically, before we talk about the indicators, I want to explain that indicators have three types: trend indicators, oscillator indicators, and volume indicators. So what are the trend indicators? Trend indicators are used to show us what phase we're in, what the leading trend is, whether it is bullish, bearish, or maybe sideways. Let's just go straight to the start. I often use moving average, Bollinger Bands, and support trends for trend indicators. Then, oscillator indicators are indicators used to identify the lowest and highest points of a price. Usually, these points indicate oversold and overbought on condition. When it's below, it indicates oversold, meaning it might go up. When it's above, it is usually overbought, indicating it might go down. That's the function of oscillator. There are several oscillator. First is RSI, relative strength. This is the most common and widely used oscillator. So you can see here, below is oversold, above is overbought. Then second, there's MACD. MACD is used to see histogram formation and crosses. When it crosses, it indicates that its momentum is going up. Like this, the one I often use is stochastic. Usually, I use a 533 setting because it's been proven responsive in this market. I've been using it for years. So when it's in the oversold area, then it crosses, indicating that the price is going to spike up crazily. But when it's already above, what happens? Overbought. And then when it crosses down below, it's already saturated. It might go down, the price goes down, then the oscillator cools down to the oversold area. Then it crosses up again, and this analysis is very easy. Then third, there are volume indicators. What are volume indicators? Volume indicators show how much market participation there is. So, volume indicators can be used to see if a breakout is valid or not. So, when for example the price consolidates, then it breaks out at a certain level, but it's not supported by volume, what happens? It tends to be a false breakout, so the breakout might go down later. But if it breaks out upwards and the volume also breaks out, it means it is valid breakout. Now, there are several oscillators. One of them is unbalanced volume. This shows the level of participation in the form, which is depicted in a line. Then there's volume divergence, how it goes up and down. So the function of crystal analysis is the final analysis you use. So this is not something to be removed. If one trend is already bullish, that means you should go long. Then secondly, look at where it's long. Long at support, then look at the pattern. Oh, found a double top, search, zoom in again to M15. Turns out the indicator is in the oversold zone or there's a hammer in M15, then execute the trip. That's the information composition to find the wheeling.